Okay, we ended up in our last session looking at the Social Security benefits and the taxability of those. So what I want to do is just kind of go over that calculation, the handwritten one that I sent you and we went over, just so you can understand how that works. And then we're going to go ahead and finish up the chapter. We'll go ahead and finish up the chapter. Basically, as I indicate with this calculation, if you have modified AGI that is less than the lower limit, and there's two limits based on if you are married, filing jointly, or single, head of household, or a widower. As long as it's here, it's not going to be taxable. So anything under these lower limits is not going to be taxable. Anything between, it's going to be the taxable portion of the Social Security is going to be the lesser of 50% of the Social Security benefits, or 50% of the excess of the modified AGI over that lower limit. Okay, if your modified AGI is more than the upper limit, meaning it doesn't fall in between, but it falls above the upper limit, then your taxable Social Security benefits are going to be the lesser of 85% of your Social Security benefits, or the sum of 85% of the excess over the upper limit, and the lesser of 50% of your Social Security benefits at $6,000. So basically what you do is you say, okay, what's the smaller of 50% of my Social Security benefits are $6,000, and I take the smaller of that, and then I'm going to add it to 85% of the excess over the upper limit, and then I'm going to take that sum, and then I'm going to compare to 85% of my Social Security benefits, and then the lesser of the two is going to be the portion of my Social Security benefits that are taxable. So, as I said, hopefully you had some time to go through that calculation, and therefore you could see the calculation, that is a little easier than the worksheet. But either way, you'll get the same answer. If it's easy for you to follow that worksheet and go through the calculations, you'll be fine. If you're using a tax software, there's one that comes with our textbook, or any one of the ones you purchase. It'll go through that calculation for you and let you know the amount of your Social Security benefits that will be taxable. Okay, let's continue on with the chapter. Next, unemployment compensation. And we know unemployment rates are up. The important thing to remember, if you're receiving unemployment, it's going to be taxable. And they don't always withhold taxes from your unemployment compensation. So just be aware, if you're receiving unemployment and you're not getting taxes withheld, it's going to be taxable to you, and it's going to cause you to have to pay tax on the amount that you receive. I want to say the state of Kansas may offer you to withhold it versus the state of Missouri, but just inquire. If you're receiving unemployment compensation, be it in Missouri or Kansas, inquire whether they'll withhold tax on it for you. Or you just may choose not to, and just be aware it's taxable. Next, we want to look at employee fringe benefits. Basically, as employees, we get certain benefits from working at certain places. It's a fringe, it's a benefit for working there. And basically, they say all these employee fringe benefits are included in income, except for these ones that we're going to discuss that are specifically excluded. And we start those on page 2-21. Okay? And so, employer-provided spending accounts. This is money that's set aside for dependent care accounts, which you can set aside $5,000, just taken out pre-tax to cover child care or aging parent care, or medical flex spending accounts that help cover medical expenses. So basically, these accounts you can use for medical and for child care. They take out pre-tax, so you get the benefit of it not being taxed. And because the employer runs these plans for you, you do not have to pay any income or any, for that benefit. So excellent options there. Also, this is going to happen mainly in maybe a big city where they encourage you to maybe take the subway. But if an employer provides a spending account for public transportation, there's monthly limits that's going to apply, and it's to cover the public transportation to work and for parking. So if all the requirements are met, then it's going to be a tax-free reduction. So like I said, normally that's going to happen in big major cities, New York, Chicago, where parking sometimes is an issue if you're working downtown. So they're going to try to encourage you to catch the subway. Next is group term life insurance. If and a lot of employers do this, employers can pay up to $50,000 for employers tax-free for group term life insurance. Now, the thing about that insurance is it cannot favor officers, shareholders, or highly paid. It has to be offered to everyone across the board. Okay, and then they have what they call no additional cost services. These are provided at no additional cost to the employee. Okay, and it's only allowed if it's in the employee's major line of business. An example of these, if I work for an airline, the perfect example, as we know, people who work for airlines have the option of maybe flying standby and being able to fly for free. It doesn't cost you any money. It doesn't cost the employer any money to have that vacant seat filled by you. So in that case, it's not taxable. Now, the thing about it, it has to be in the employee's major line of business. Let's say I work for a corporation who owns a hotel chain and they own an airline. If I work for the airline, even though the corporation may give me a discount at the hotel and for airfare, the airfare is the only one that's not taxable to me because that's in my line of work. I work for the airline piece. But for the benefits that I take for the hotel, if I get free rooms or whatever, then that is going to be included in my income. So it's only for the line of business in which I work in. So keep that in mind. It's going to be only for the line of business that you work in. Okay, qualified employee discounts. We know if you work at certain places, you can get a discount. And as long as these discounts are provided on a non-discriminatory basis, and then there's certain limits to them. They said these particular discounts are not going to be tax-free. If they're on real estate or investment property, so if you're getting a discount on real estate or investment property, that's not tax-free. You're going to have to include that in income. If the discount exceeds the gross markup of merchandise, basically, if because they're selling it to you, they're selling it at a loss, that's not going to be excluded from your income. That's not going to be tax-free. You have to include that. If the discount exceeds 20% of customer price, basically the exclusion limit is limited to 20% of the customer price. So if it's more than that, then that portion is going to have to be included in income. And once again, if it's out of the employee's line of business, back to me at the hotel, if I'm getting a discount and I work for the airline portion of it, it's out of my line of business. An example, I used to work for the Kansas City Royals. We had an option of getting the Royals tickets. We get, for free. No problem going to a Royals game. I work for the Royals. If for some reason the same owners of the Royals own the Chiefs, and which, that's kind of a gray area because we're still in, but one's professional baseball versus professional football. It would be probably challenged that my tickets or free tickets to the Chiefs may have to be included in my income. It's not the same line of work. I think you could argue that, professional sports is professional sports. And maybe if we threw in a hotel or something, then we would begin to say, okay, that portion is not in my same line of business. So just know you have some gray areas there and that you could, that would be up for discussion. Okay, also they have a working condition, another one, excluded. These working conditions benefits are excluded to the extent that the cost of the property or services would be a deductible expense. Meaning, if this was something I'm going to get a deduction for anyway, if it's a deductible expense anyway, therefore, it's not going to be included in my income. The example is if your employer pays for your professional dues. If you belong to the AICPA or you belong to a professional organization and your employer pays the dues on your behalf. And that is a deduction anyway. So therefore, since it is a deductible expense, my employer pays it for me, I wouldn't have to include it in my income. And that's because it's already a deductible expense. Okay. These de minimis fringe benefits, these are like little small ones, so small that we don't necessarily account for them. The de minimis fringe benefits are excluded from income, if they're too small to account for. If it's too tedious to try to track them, they are not going to be included in our income. Also, subsidized lunchroom. If you have a lunchroom on your at your employer and it's subsidized, long as it's on or near the business and that the revenue from the operations exceeds the cost, meaning they're operating at a profit, and that anybody can use it, it's on a non-discriminatory basis, that subsidized lunchroom, the benefits you get from that is not going to be included in your income. So, okay, tuition reductions that are given by educational institutions. For instance, here at Johnson County, we get particular tuition reductions. So those tuition reductions are excluded from income if it's for undergraduate and it's available to all employees, all, say, full-time employees, meaning, and also it's available to spouses and dependents. Then that benefit of taking classes at a tuition deduction or at no cost is not included in income. For graduate level education not to be included, the employee has to be at an institution that is teaching and research. So that's the way graduate level can be excluded. Athletic facilities. We have an athletic facility. A lot of companies have athletic facilities on campus or on the job site. That cost is excluded if the cost to operate the facility is used primarily for employees. So if it's used primarily for employees, it's not an outside place, then that cost of using that facility for free would not be included in your income. And then a lot of times companies offer to provide some retirement planning. They may have a company come on site and give some free advice on retirement planning. If it's provided value is going to be excluded from gross income. Now that's just the retirement planning piece. If you have the ability to, for free, go get your taxes done, or some type of accounting fees or accounting services or legal and brokerage services, those don't apply. Only retirement planning services. So tax prep, you have to include that value in your income. Any accounting services, you have to, if you're getting those for free and your job is providing them, then you're going to have to include the value of those in your income. You're going to have to include the value of those in your income. Okay, that brings us to the end of Chapter 2 that dealt with gross income and exclusions. We dealt with a lot of things that we looked at first, what was included in income. And the IRS, remember, they say everything is included, not unless it's specifically excluded. Then we began to look at specific items that were not included, that were partially taxable. And so we begin to look at specific items like that. So that is Chapter 2 that dealt with gross income and exclusions. Okay. We want to go ahead and move on to Chapter 3, which is going to deal with business expenses and retirement plans. This session is going to deal with the beginning part of that, which is your business expenses. So in your packet that I sent you, you should have a handout that in this particular one, we're not going to do it by PowerPoint, but it's all by notes. We have notes that you're going to be writing and filling out on a handout that I sent you that says Chapter 2 Business Expenses and Retirement. So let me get a blank one and we will get started. Okay, so that is the handout that you should have for Chapter 3. And so we have a lot of notes for this chapter. There's a lot to cover in here. And we're going to basically cover it all this way. So there's no PowerPoint that goes with this chapter, but it's going to be all done by notes. We want to start with our rental income. We want to start with rental income. Rental income is going to be taxable. Okay, rental income is taxable. Okay, it's going to be taxable on Schedule E. Okay, and then it's possibly that it's going to be treated as a business and possibly be taxable on Schedule C, meaning if there is some cleaning and maid service being provided on this rental property. And probably what we're distinguishing between is rental property that people live in versus hotels. Hotels and bed and breakfasts where there's cleaning and maid services that are coming in, then that's more of a business and Schedule C. To where if it's rental, strictly rental property with someone, you rent out a piece of property, then that's going to be Schedule E. So that's the difference there. With Schedule C, this is going to be subject to self-employment tax. Okay, that's going to be subject to self-employment tax. So that's your distinction between those two. Okay, and so we want to start off on page 3-2 where they talk about vacation homes. Basically, vacation homes can be both personal and rental use. As we know, if I have a vacation home up in Colorado where I ski, I am probably not going to just leave it vacant if I can when I'm not there. I would like to have it rented out. Okay, so when we have vacation homes that are both personal and rental, the use of that property, then what we're going to need to do is allocate the expenses. We're not going to be able to take the, just deduct the whole thing, because you got to remember there's some personal piece in there. Okay, so the way they separate it out, if you begin to look on page 3-2, there is rental that's going to be considered primarily personal. So we have rental that's considered primarily personal. Then we have rental that is considered primarily rental, meaning when we look at it, that's really personal. And when we look at it, that's really rental, primarily rental use with not much, if any, personal. And then we have the rental that is personal and rental. So it has a dual use. Okay, so let's look at what qualifies for these items. How does a home qualify as primarily personal use, and then how is it taxed or how is it treated? Okay, so when we're talking about property that is primarily personal use, it's going to be rented for less than 15 days. So it's going to be rented for less than 15 days. So 10, 12, but less than 15 days is going to be rented. Not equal to, less than. Okay, so if that's the case, it's going to be treated as personal. Treated as personal. Okay, and then the rental income for that particular property is not taxable. Is not taxable. Okay, so the mortgage interest and taxes on that particular property are going to be deductible on Schedule A. So we're going to be able to take those deductibles. And any other expenses are not deductible because they're personal, because we deemed it not to be rental property. So even though I can't deduct any of the other expenses, guess what? The income is not taxable. The perfect example of this is we just went through the inauguration. And I had an opportunity to go to the inauguration, and there was lots of advertisements regarding people renting out their personal homes for the inauguration week or weekend or whatever the case may be. I had the opportunity to get a hotel room, so I didn't have to do that. But you think about it. And some of them were renting them for huge amounts of money. So if let's say that I decided to rent out my home for the weekend at a rate of $5,000. Well, I rented it for less than 15 days. So that's going to be considered personal. And none of that income is taxable to me. None of that income is taxable to me. So keep that in mind. When it's primarily for personal, long as it's less than 15 days, income is not taxable. Now, any expenses they incurred, to get it ready for rent or whatever the case may be, that's not deductible. But they can still deduct their mortgage interest and taxes. So that's a perfect example of personal property that I did get some rental income on that I don't have to, claim on my tax return. Okay. What qualifies property as primarily rental use? What qualifies property as primary rental use? And this is when it's rented for greater than or equal to 15 days. Okay. So I got that in. I rented it more than 15 days or equal to that. And there's an and in this. And the personal use does not exceed, so there's a personal use, does not exceed, okay, the greater of either 14 days or 10% of the rental days. Okay, so we have to look at the personal days and the rental days. So if I've rented my property for more than or equal to 15 days, and the personal use days does not exceed either the greater of 14 or 10% of the rental days, or 10% of the rental days. So long as that happens, then this is going to be considered primarily rental use property. Okay, when it's primary rental use property, I want to allocate the expenses between rental and personal. They're still not going to let you take those personal expenses. Okay, and then I'm going to do that allocation based on the rental days divided by the total days used. Okay, so I'm going to take the rental days, the number of days that I actually rented, I'm divided by the total days used, and that's going to equal my rental percentage. And then I'm going to take the expenses, and I'm going to multiply them down by this rental percentage. And that's going to equal the deductions I'm going to be able to take. Okay, and then for the personal piece, the personal days divided by the total days used. That equals my personal percentage. And then in that case, the personal part is not going to be deductible. Okay. The good thing about when it's primarily rental use, if I go through my Schedule E and I report my income minus my expenses and it ends up with a rental loss, that rental loss is allowed. I can deduct a rental loss. So a rental loss is allowed on my Schedule E. Okay, so that is the benefit of your primarily rental use property, is that if it's primarily rental and you end up with a loss, then it's a deductible loss. You can take the loss. So that's the good thing about that one. So primarily personal, I have income, I don't have to report. Primarily rental, I can deduct the personal percentage of my expenses, and if I end up with a loss, then that loss is fully deductible. Okay. Next is, what if we have property that we consider a rental personal split or dual use, meaning I've used it a little bit of both. So what qualifies a piece of property for that? What qualifies a piece of property for that? The way that works, if it's rented for greater than or equal to 15 days, and the personal use exceeds, remember in the other one we said that greater than or equal to 15 days and the personal use does not exceed. So now we're at and the personal use exceeds. So in the personal use exceeds the greater of are 14 days or 10% of the rental days. Okay. So if you go through that calculation and that applies, my personal use exceeds the greater of those, then that in that case it's going to be a rental personal split. Okay. And so what you're going to do is you're going to you want to allocate the expenses between the rental and the personal. You want to allocate the expenses between the, just like we did before, you want to make that allocation. Now, the thing that to note and remember that there's no loss allowed. So if I go through the calculations, I got my income, these are all my expenses, and I end up with a loss, I can't take that loss. The only thing I can do is deduct expenses in the following order up to income. So basically up to where I have a net income of zero, meaning I'm going to, if my income is $5,000, I can only take $5,000 of expenses. Okay, but they're going to make me take them in this order. I'm going to first have to deduct taxes and interest. So I'm going to do that first. Taxes and interest, that mortgage interest and taxes, I deduct those first. Now, if after I deduct those and I end up with a loss, then that's okay. Now, these can create a loss. Okay, create a loss. These can't, they're allowed to create a loss. So, for instance, if my income is $5,000, if my taxes and interest equals $6,000, which makes me have a $1,000 loss, I can take it. Now, I'm not going to get any utilities or depreciation because I've already consumed all my income. Now, utilities and maintenance would be deducted next. And then any depreciation. Okay. Now, this personal rental split, that personal percentage of mortgage and interest. So, mortgage, interest, and taxes, they can go to Schedule A. They are deductible on Schedule A. Okay, when it was primarily rental, that person percentage, I didn't get to do anything with that. But in this case, the personal percentage is going to get to go on Schedule A. So let's review this one. This is deemed or determined to be a rental personal split based on that the rented days are greater than or equal to 15 days and my personal days exceed the greater of 14 days or 10% of the rental. Okay, and so what I'm going to do is allocate still between my rental and my personal portion. If I come up with a loss, I cannot take that loss. No loss is allowed. I can only take expenses up to my income. I take my expenses in this order. I deduct my taxes and interest from the rental property. If I still have income left, I'm going to deduct my utilities and maintenance. And if I still have income left, I'll deduct the depreciation. You have to do it in this order. The personal percentages then of your mortgage, interest, and taxes are going to be deductible on Schedule A. So you don't lose those. You do not lose those. Okay. Now, an interesting thing is this alternative allocation method. There's an IRS method, and then there is a tax court method. Okay. On page 3-4, it should be noted that the U.S. Tax Court has allowed taxpayers to use 365 days for the allocation of interest and taxes instead of what I spoke of here. Here I said take your rental days divided by the total days used. Okay, this is considered the IRS way of doing it. If we take, to get my rental percentage, if I take the rental days and I've divided by the total days used, okay, the alternative approach would be to take the rental days and divide them by 365, the whole year, and get the rental percentage. So the question is, why is that a big deal? And this is for my interest and taxes allocation. This is, so that I can deduct or allocate my personal versus my rental. So the question is, why is that a big deal? What's the big deal? Why does it matter? When we do this, we come up with a smaller percentage than if we did it the rental days divided by the total days used. Okay, because we may have some vacant days. If it's not used every day, we're going to have some vacant days. You're going to come up with a smaller percentage. We like this because what happens is that when I come up with this smaller percentage, okay, then I'm going to have a smaller amount deducted on my Schedule E. Okay, so basically when I go through this process, this is a small amount, which lets me take more here. So that's gonna, if this is smaller, then it's gonna allow me to deduct larger utilities and a maintenance amount and maybe get some of that depreciation. Okay, if I use the IRS approach, this number is gonna be larger. So I'm gonna consume all of this with my taxes and interest. So that means I lose this. The thing about it is you're gonna get the taxes and interest. Either they're gonna be on Schedule E or they're gonna be on Schedule A. So what this does is it pushes more of those to Schedule E. Schedule A. And what it does, I get a smaller deduction on Schedule E, and it pushes more of those expenses, basically moves more of your taxes and interest to Schedule A. Okay? It moves more of those to Schedule A. So that's a bigger benefit. So, of course, the IRS wants you to use their method. We want you to use, we would like to use the tax court method. And on page 3-4, the last little sentence, it tells us that there's controversy between the tax court decision and the IRS. It hasn't been resolved. Okay, so people routinely go take the tax court method, and it's held up in court. The IRS would like for us to take the IRS method, but of course we want to get more of those expenses deducted on Schedule A, and that frees up me to be able to end up deducting my other ones. So just a real brief review before we move on to the next subject. Rental is taxable either on Schedule E or C. If your home is deemed primarily personal use, meaning I rented it less than 15 days, then it's going to be treated as a personal use or personal, and I'm not going to have to report any rental income, and I deduct the mortgage, interest, and taxes on Schedule A. And that's like a second home. You can take mortgage and interest on a second home. If it's deemed primarily rental use, meaning I rented it more than or equal to 15 days and my personal use did not exceed the greater of 14 days or 10% of the rental, I need to allocate my expenses between rental and personal, either based off the IRS or the tax court method. And the rental portion is going to be on Schedule E. The personal portion I don't end up getting because this is not deemed, once it's deemed primarily rental, this is not a second home for me. This is rental property. So I can only deduct that interest and taxes on Schedule A for a second home. So this is not a second home. So that personal use basically is lost. I'm going to lose that. And the good thing about this is, though, I can end up deducting a rental loss on Schedule E because it's a business and they're going to let me take that loss. Okay. Next, if we deem the property to be a rental personal split. If we deem it to be a rental personal split, that means I rented it for more than or equal to 15 days, and the personal use exceeds greater of 14 days or 10% of the rental. And I'm going to still allocate between rental and personal, once again using the tax court method or the IRS method. Now, one thing here is that there's no loss allowed. So if you have more expenses than income, you deduct your expenses in this order. First, deducting taxes and interest, utilities and maintenance, and then depreciation up until the income that you have. The personal portion of your mortgage and interest, because now this is deemed as a second home, then it's going to be deductible on Schedule A. It's going to be deductible on Schedule A. So that is your rental property. That's your rental property. Okay, let's move on. Still kind of dealing with this is passive activity losses, and they call them PALs, passive activity losses. We picked that up at the bottom of page 3-4. Okay, so the question is, we initially talked about passive versus active income versus portfolio income. So when we're looking at passive losses, we're going to be concerned about our passive income. We want to be concerned about our passive income. Passive activity losses, basically we're dealing with passive losses is what we're looking at. Okay, passive losses may not be used to offset active income. So basically, I can't use a passive loss to offset my salary. Salary is considered active income. So I cannot use a passive loss to offset my salary because it is active income. Okay, so the question is, what is basically a passive loss? These are ventures that a taxpayer is involved in, but they're not actively. So a taxpayer is not, they may just be an investor. They're not actively involved. So they have a passive role. So if that venture generates a loss, that's considered a passive loss. Okay. Passive losses can only offset passive income. Okay. So if I have a passive loss, I have to be able to have a passive income in order to get it, to offset it. Okay. Any excess losses, because I don't have enough income to take all my losses, any excess losses are carried forward. So any excess losses are carried forward, or I can deduct them when I sell the investment. Because maybe it never generates any income. So I would just hold on to those losses until I sell the investment. Okay, so that's a brief overview of passive losses. They are a lot more detailed than that, but I just kind of want to briefly cover them. Now on page 3-7, they talk about real estate rental, which we just talked about, rental activity. Now they consider the rental of real estate a passive activity. Okay, so we just talked about rental and the deductions of losses. So they consider real estate rental a passive activity. So the question is, now do I have to follow these passive loss rules? Well, there's some special rules for rental. There's some special rules for rental, and then they even determine what's considered a trade or business, meaning I'm in the business. That's what I do. I rent out real estate. That's all I do. Or is it truly a passive activity for me? Is it truly passive activity for me? If you look at the bottom of page 3-7, taxpayers who are heavily involved in estate or rental activities, they may be able to qualify theirs as a trade or a business rather than as a passive activity. So if you are heavily involved in it and that's your business, that's what you do, then you're saying, well, that's not a passive activity for me. I'm actively. So that income and losses from that activity won't have to meet these passive loss limitations. In order for you to say that you're actively involved and that they're not passive, so in order for you to say, let's put this in parentheses, that they're not passive, then you want to meet those requirements that's on page 3-7. And it says that more than 50% of the individual's personal service during the tax year is performed in the real property trade or business. So more than 50% of what you do is in this trade or business. And then number 2, that the individual performs more than 750 hours of service in the real property trade or business in which he or she claims material participation. So the taxpayer must materially participate in the activity, and to satisfy that, it has to be more than 50%, and then the individual performs more than 750 hours. Okay? So that's very important. Income from passive investments. So in that case, it's not passive. I can take it as a trade or a business. It's not an issue. I get to take the deduction. Any loss, it's not considered passive. Okay? For real estate, just real briefly, for a real estate property that's considered passive, they have allowed you to take a deduction. You may deduct up to $25,000 of losses against other income. So even though they're going to deem it to be passive, they do allow you to take a $25,000 loss. Now, if you are a high income taxpayer, you may lose some of that loss. So keep that in mind. And then once again, like I said, if it's not passive, then there's no loss limitations. And as long as you meet those requirements, you should be well okay. Okay. So if the real estate is the real estate rental equals a trade or a business, meaning it's not passive and you've met those rules, then you have no loss limitations and it's not considered passive. So you just want to make sure you follow those rules that's on page 3-7. Okay, let's move on to your bad debts. Move on to your bad debts that's on page 3-8, your bad debts. Okay. For instance, if we're talking businesses and we're talking bad debts, these are the situations we're probably kind of talking about is when you have uncollectible accounts receivables. Okay, so if we have uncollectible accounts receivable, then we have a deduction. Our deduction is going to be limited to what we previously included in income. What we previously included in income. And the example is just, let's say that I have a sale and let's say I have, I don't know, $50,000 worth of income versus sales, and I report that. And of those $50,000 worth of sales, I have $20,000 of that's our accounts receivable. I report the $50,000 and I show the $20,000 as accounts receivable. If $3,000 of those accounts receivable become uncollectible because I've reported the income piece to it, then I can deduct it. Now, if you are a cash basis taxpayer, okay, if you are a cash basis taxpayer, meaning that you're not going to report your income until you receive it. So even though you have an account receivable, you never report it until you receive it as income. So therefore, since it never was reported as income, it is not a bad debt. You cannot take a bad debt. So cash basis taxpayer are not allowed the bad debt. And that's because it was never included in income if you are a cash basis taxpayer, because cash basis, they're going to report their income when they receive it, not when it's earned. Okay. And so with these bad debts, you can take the deduction. You want to use the Pacific charge-off method to do so as you take these bad debts. Okay, and so basically you want to deduct them as they become partially or completely worthless. Okay, so basically it gives you a benefit that, I have this income, I reported my income, I never got it. It's not fair because I pay taxes on it. So therefore you can take a bad debt deduction for those uncollectible accounts receivable, just as long as you've included them in your income. Okay, so next we have the business versus the non-business portion of that. The business versus the non-business portion of that. The business, okay, the business portion of that is any debt from a trade or business. Okay, and so when we're talking about a debt from a trade or business, similar to what we were talking about up here, this is an ordinary deduction. It's an ordinary deduction, and you can take it against ordinary income. So it gets to offset, this bad debt is going to get to offset ordinary income, and basically is going to appear on Schedule C. It's going to appear on Schedule C. Okay, so what we'll do is in our next session, we'll start with our non-business bad debts and talk about those. And then we will probably have enough time to finish up Chapter 3. So we will look at business, continue to look at business expenses, and then we will look at retirements if we have some time. So that's the end of this session. Make sure you're looking through Chapter 3. We finished up 2, so you need to make sure you do your multiple choice questions for Chapter 2 and get those sent to me. So that's it until our next session.